Hey, it's Soleil, and this is episode 186 of the Orange Pill Investor. And of course, MicroStrategy is down like a mofo. Uh, but scrolling out, give you a little bit of perspective. It is up 100% year to date. But today I want to talk about the results of the little test that I did regarding whether IV crush affects long dated calls or not. There is a phenomenon that occurs after earnings, and the MicroStrategy chart really doesn't illustrate it very well. Let me just try to find something. I'm just going to click anything and then look up Tesla. This is Market Chameleon. This is a pretty nice tool for tracking implied volatility charts. This is a much better example. Not this one so much, but as earnings approaches, like this is kind of the baseline implied volatility for Tesla. And then it increases up to a certain point. Then you get earnings results, and then the air is let out of the balloon. There's no more wondering, is the stock going to go up? Is the stock going to go down? Are the margins going to do this? Are the margins going to do that? And so then the price can go up or down or trade sideways. That doesn't really matter. But implied volatility for Tesla was 52.6. And then, immediately after that, boom, it's down to 42. Language is down here. Generally, implied volatility is considered a mean reverting stat. So you'll have your kind of baseline, and it can dip and it can spike, but it will generally just kind of revert to the mean. And then you can see it happening again. There must have been a shitload of anticipation around this earnings call. And then boom, it just collapses again. A lot of times you're collecting your best premium here. And then some people even have earnings plays where they will sell this volatility right before earnings, and they'll just buy it right back the day after earnings, capitalizing on IV crush. And same thing here. But you can see MicroStrategy has a terrible chart if you are an earnings player that sells options before earnings, and then you're expecting to capitalize on IV crush after earnings are reported. So one of the things that I wanted to do was to take a peek at the implied volatility of at the money options, something that was in the money, and some strikes that were out of the money, and then see if the ones that were under 90 days really were affected by IV crush, which I expected to be true. But then I also wanted to look at these that were greater than 90 days. And I was kind of suspecting that they wouldn't fall prey to IV crush because it's going to be the next earnings date that affects this expiration date. And it'll be earnings a year and a half into the future that affects this expiration date. And then this one was like, was that 6 months in the future, whatever. And as you can see, for the short dated, this was done on August 1st, the day of earnings. So right before, God, my nose itches like crazy today. Right before earnings were announced, and then I did my next test at I can't remember if it was like 10, 11, 12 in the morning. The price of MicroStrategy did move down, so my at the money strike was at 1545 before earnings, and then it was 1465 after earnings. And then I went ahead and slid my strikes down as well. Since I went from at the money of 1545 to in the money 1400, I went ahead and went down $145 from 8.2s at the money price. I was trying to compare apples to apples. It wouldn't have been fair to look at the 1545 strike the day before, look at the 1545 strike the day after, and then this thing was way out of the money. It would have been like $100 out of the money. So, with all that being said, this is just one test, but I'm reasonably confident that this kind of proved the case. To really be certain, I guess you'd have to do this multiple stocks and multiple expirations and whatnot. But it's pretty clear that from 8.1 to 8.2, the very next expiration date, implied volatilities, went haywire. So day before earnings, at the money went from 124 to 184. In the money went from 150 to 165. Out of the money went from 134 to 203. And even way more out of the money went from 287 to 591. So implied volatility actually went up. In general, we talk about IV crush going, implied volatility will go down. However, when you get a sharp move in a stock price, that will also drive up implied volatility. So that's why these numbers are all going up instead of what we would normally see them going down. But I still think that this proves that this binary event affected the implied volatility for this ticker. And when I went to 106 days, you can see that it was very similar. So at the money, 97 to 99, 97, 99, 97, 98. Going all the way out to 686 days to expiration, 89, 89, 89, 90. You can see that these were pretty much unaffected. And it kind of makes sense. Like a year and a half from now, why would this implied volatility on these options give a damn what happened in August of 2024? And then I went ahead and took a look at these 3,800 strikes because these are the ones that I generally buy because they're the cheapest. So they're the most affordable. And I own some of these as well, I think. I can't remember why I looked at these. But these are not quite leaps because they're only 204 days. Generally, people consider leaps to be at least a year out. But these were also unaffected. And you can see where we would normally expect IV rank to go down, it actually went up by 4. And that was likely due to MicroStrategy's price tanking, which will drive up implied volatility. So I'm reasonably confident that this demonstrates that IV crush only affects the very next the short dated days to expiration. Potentially anything that expires before the next earnings call. And I actually didn't think that to do this, but I probably should have checked a bunch of these days to expiration. So I should have checked like 8 DTE, 15 DTE. I should have checked a bunch of these. But most certainly by 106 DTE, implied volatility was largely unaffected. This little 2-point move was probably from MicroStrategy's price collapsing. But why does that even matter? Maybe I should have explained why this matters and why I even wanted to do this test. So one strategy that I use and that other option traders also use is, since we are expecting implied volatility to collapse after earnings, then this can be the optimal time to buy long calls. So I'm primarily an options seller. So all of these high implied volatility days here get my juices flowing, and I start salivating because I want to sell options here. And then if I'm still holding them after earnings, I can buy them back cheaper. But if I reverse that thinking and I think, okay, I want to buy long calls in Tesla, or I want to buy long calls in MicroStrategy, the optimal time could be after earnings if I see earnings crush, IV crush happen. I haven't really been seeing it, and it will be interesting to see what happens after the split, if this chart changes at all. But just in general, it doesn't really look like, if someone wants to buy cheap long calls and they think they're going to do it after the day after earnings, it's only going to work on expiration dates prior to the next earnings report. So this is August. The next earnings is going to be what, November? September, October, November. So any expiration date before November 1st or whatever, we're probably affected by IV crush, and anything that expires after MicroStrategy's next earning report are probably unaffected by it. So you're not necessarily getting a discount if you're waiting to buy leaps for the day after earnings. But if you're going to buy a, let's just look at the options chain. Any long calls before November. So this November 15th would probably be after earnings. So October 18th and earlier might be cheaper. Not financial advice. Gets annoying having to say that all the damn time. But these long calls are certainly going to be at a discount because the price is cheaper. So this 19% change on the price isn't necessarily a reflection of IV crush, but could be just as likely from MicroStrategy being down. And now that I think about it, so this is October, that's 76 days. I generally try not to buy options this short of a date of expirations anyway. But if I had to, I could buy these and hold them for 2 weeks. I absolutely will not hold any long calls under 60 days. I try to unload them at 90 because theta just gets too big. As an option seller, anything under 60 days, those are the contracts that I'm targeting, because actually not delta. Why am I highlighting delta? Theta. Sorry, theta gets bigger as we get closer to expiration. And so when these long calls get under 60 days, theta is just getting brutal compared to the value of that option contract. And that's why I'm selling. I'm selling anything under 60 days, generally 7 days. But the sweet spot, if you're going to go longer than 7 days, is probably 45 days, according to Tasty Trades research. And yeah, so I guess this could be a possible strategy. This long call is cheaper now, and I don't know. I suppose there could be some kind of there could be an advantage to buying this after earnings and then holding it for a couple of weeks in case MicroStrategy pumps, and then you could turn around and make a profit off of these. But I I I think it's probably an urban myth that you can get these 684-day leaps cheaper after earnings. I don't really think that this option contract gives a shit about what happened after earnings 2 years, a year and a half earlier. All right. That's the results, and be interested to know if folks have any comments or questions about this, and whether your experience matches this, or if you've experienced the complete opposite. We're great to hear about that. All right, be good, Joe.